Microsoft just beat earnings. Revenue came in strong. Profits were up. And yet the stock dropped more than 10%. In a single day, billions of dollars in market value disappeared. So how does a company post good results and still get punished this hard? Because what Wall Street reacted to had almost nothing to do with this quarter, and everything to do with what comes next. When most people think about earnings, they assume it's simple. Good numbers mean the stock goes up. Bad numbers mean the stock goes down. But that's not how markets actually work. Markets don't move based on what already happened. They move based on expectations. And heading into this earnings report, expectations for Microsoft were massive. This wasn't just another tech company reporting results. Microsoft is viewed as one of the leaders of the AI revolution. Investors expected strong cloud growth, accelerating AI revenue, and clear signs that the billions being poured into artificial intelligence were already paying off. Especially through Azure. Azure has been Microsoft's growth engine for years. As long as cloud growth stays strong, the entire business story holds together. But this quarter, something changed. Yes, Microsoft beat earnings. But Azure growth slowed. Not collapsed. Not crashed. Just slowed enough to make investors uncomfortable. At the same time, Microsoft revealed how aggressive its spending has become. Billions are being poured into data centers, into custom AI chips, into energy, cooling, and infrastructure needed to support massive AI workloads. And this is where fear entered the picture. Because AI may be the future, but the future is expensive. Microsoft is spending huge amounts of money today, while the payoff may come years later. That creates a dangerous gap. High costs now. Uncertain returns later. And markets hate uncertainty more than almost anything else. So when investors saw slower Azure growth combined with rapidly rising AI spending, a new question formed. What if margins shrink before AI revenue meaningfully shows up? What if profits get squeezed during the transition? This is why the sell-off happened so fast. It wasn't retail investors panicking. It was institutions reassessing risk. Because Microsoft isn't being judged on what it earned last quarter. It's being judged on whether it can turn AI into real, scalable profits fast enough. That's the real concern. And this is bigger than one earnings report. Microsoft is in the middle of a massive transformation. The company is betting that AI will define the next decade of technology. But during that transition, growth can slow, costs can rise, and confidence can wobble. That doesn't mean Microsoft is failing. It means the market is adjusting expectations. Going forward, three things matter more than anything else. First, Azure growth. If cloud demand reaccelerates, confidence returns quickly. Second, AI monetization. Investors want clear proof that tools like Copilot are driving real revenue, not just excitement. And third, margins. Wall Street wants reassurance that spending won't spiral faster than profits. If Microsoft shows improvement in even one of those areas, sentiment can shift fast. Because fear works both ways. Just like panic can spread quickly, confidence can return just as fast. The biggest lesson here is simple. Stocks don't move on good or bad news. They move on the gap between expectations and reality. Microsoft beat earnings. But it didn't beat the future investors had imagined. And that's why Microsoft beat earnings, then this happened.